Hi, my name is Lawrence. I'm the author of Financial Freedom Through Property. One of the questions I get a lot from my students is it better to invest in a new build or in a property that's been already built many years ago? An example like a CBD kind of area. So in this short series, I'll be analyzing several new builds and just showing why investing in new builds can be risky and can be difficult. If you haven't already, please subscribe, click the notification button, join this tribe. I'll be sharing, as I always do, weekly updates and weekly videos, so make sure that you don't miss out on everything property related in the South African market. Welcome back to another episode of the series of the New Build Dilemma. Now, new builds is a very attractive way for people to get started in property investing because you're buying something that's shiny, that's new, that doesn't require any maintenance. And new build developers and marketing teams for these companies are very good at painting the picture of a new build being a very good, sound financial investment. In this series, we're going to unpack whether it's better to invest in a buy-to-let or into a new build. And the answer, quite simply, is it depends on your strategy, right? Both have pros and both have cons. If you look at your lower income sort of CBD market approach, you're buying properties for 2, 3, 400,000. You're renting for 6, 7, 8,000. You've got more than enough yield to be able to earn a cash flow, a profit at the end of the month. Right, so your income is higher than your expenses, leaving you with a positive cash flow on a month-to-month basis. That's what's great about that sort of lower income market. If you're looking at new builds, the strategy is not cash flow, the strategy is capital appreciation. From a cash flow perspective, 9 times out of 10, the income is going to be insufficient to cover the expenses, leaving you with a negative cash flow in the new build strategy. Right, at least for the first couple of years, let's call it 4 to 6 to 10 years maybe. Now, where the capital appreciation strategy lacks the cash flow, it is strong in the sense that there's a likelihood or a potential for the property to appreciate in value. If you look at your cash flow strategy, the appreciation is going to be minimal, if any. If you're going to see a 3 or 4% capital appreciation rate, that would be probably quite high. Versus your new builds have the potential to appreciate a lot more. Now, I use the word potential and speculation very carefully here because it is a gambling strategy. As much as a developer will tell you that the property is going to appreciate by 8 or 10%, or an estate agent might say that to try and convince you to make a buying decision, the reality is no one knows. And for me, that's why I've chosen the cash flow strategy and avoided the new build strategy, because I don't believe in that methodology. Right, the cash flow strategy, it's about income being greater than expenses. You can predict it, you can plan for it, you get that passive annuity income. The new build strategy works well if you're happy to lose money on a month-to-month basis, but you believe enough in the area that it will appreciate over time. So let's jump into a live example, and I'll take you through how I see a new build investment. Today we'll be looking at iGrow Wealth Investments development opportunities, or their buy-to-let investment properties. Just before we get started, remember I have no affiliation to any of these development companies. I'm not being paid to trash talk or talk well about any of them. I'm just giving my independent opinion as an investor who is actively involved in the property market, just giving my perspective and my opinion on what they're offering. So here we've got their buy-to-let investment properties. So let's have a look here. So this one is in Cape Town, Burgoyne Heights. I don't know how to say that. Let's have a look. So obviously it's a new build that hasn't been constructed yet, because you can see these are what do you call them? Blueprints, I guess. So let's see here. They are selling from just under 1.2, transfer fees included. Okay. That's cool. 100% bond finance, strong rental demand in the area. So this is your Durbanville. This is northern suburbs in Cape Town. Okay, so let's have a look here. Gross return of up to 8%. So yeah, I mean, from a cash flow perspective, this is going to lose you a lot of money per month. Yeah, a lot. Let's have a look here if there's any financials. Okay, so here the yearly income, so that's obviously, the rental return that you can get per year. You're buying at that amount, so this divided by that gives you 8%. Anything under 15% is likely going to be negative cash flow. Here they do offset 55% of purchase price through the 13.6 tax incentive. So the 13.6 tax incentive, I don't really understand it, to be honest. You'll need to speak to a professional about it, but basically how I understand it is you need to buy 5 new builds and you get a massive tax rebate, and it turns these negative cash flow deals into good ones. I mean, I don't really understand it too much, but that could be a benefit. So if you're interested in the development space, I would definitely research that a little bit more and understand exactly the implications. So speak to an accountant or a registered advisor. Let's have a look here. So this 2-bedroom 1-bath is going for 1.2. Levies at 1,200, rates at 450, and rental. Okay, so I mean we can see this is not going to be a positive cash flow deal at all. Okay, so 1.2 million bond repayment on its own, and I'm thumb sucking here. Actually, let me just do it properly. So I can just go to property 24. Let's work out the actual cash flow. I can go here to mortgage bond calculator. Okay, so they're saying 100% finance, right? I think 100% finance at 1.2 million. No deposit. Let's use an 8% interest rate. You're looking at about 10,000. Okay, so 10,000 just for the bond. Then we've got 1,200 for rates and taxes. Then we've got 450 for rates. We'd probably have to put about, I don't know, 10% aside for managing agent. So 10% of 7,000 is 780, sorry. So plus 780, which is 10% of the rental for management. Maintenance budget, you wouldn't have to put in maybe a 5% provision for vacancies. And then depending on electricity and water, is it going to be included in the rent, or is that something you have to pay on top of? So are they prepaid meters, for instance, would be a key question I would ask. So conservatively, the expenses are going to be 12,780, and it's making 7,800 Rand rent. You're losing just under 5,000 Rand per month from a cash flow perspective. So again, if you really believe in the appreciation value of this property, or you found a way to use this 13.6 tax incentive in a way that can really help you, with your portfolio, I would say this is a pretty bad deal. I don't think this is an investment. It's not an investment from a cash flow perspective. Definitely not. So anyway, click like, subscribe, let your notifications know. I'm going to be doing a series of these new build analysis. So please join the tribe and subscribe, and please don't forget to share. Chat soon.